Hi friends, good evening. Welcome to the February's month of Indian economy and equity market outlook. I will start by talking about the budget. Well, the Indian economy is doing reasonably well, and if I have to describe the budget, I will like to say that it was more of a बाहुबली budget, जहाँ पे हमारी फाइनेंस मिनिस्टर ने अमरिंदर बाहुबली की तरह एक ही बजट से she tried to hit three targets. She has increased investments by allocating 33% more and made sure that it reaches the 10 lakh crore mark. She has supported consumption by giving tax cuts of about 35,000 crores and maintained the path of fiscal prudence. So ये बजट को अगर सम अप किया जाए और बोला जाए तो इस बजट को बोल सकते हैं कल, आज और कल बजट. Yesterday, we did not invest in infrastructure as much, and we did not support our businessmen. And I think that this budget is trying to rectify and correct that. आज के लिए, I would say that this budget is about supporting growth with fiscal prudence, and something similar is being adopted by finance minister. At the same time, we are taking care of the future by investing in the green growth of hydrogen and skilling millions of people who are employed today. And this right mix of correcting the past errors and the omissions will make sure that we are growing and moving ahead with a lot for the future to look forward to. Like I said, this budget can be said as kal, aaj or kal ka budget. Now, moving forward, the news headlines in India have been fairly positive. Tax collections have been good, the retail inflation have been nice, Indian railways have been doing good when it comes to the revenue. Likewise, manufacturing is doing good, fast track collection has been really nice. So, of course, there are some negative headlines too, but by and large, India is fairly positive in terms of headline messages. And it's not like we are not linked to global economy. Of course, we are linked to global economy, and if global growth has slowed down, then this could definitely impact our economy inflows. But for the moment, the momentum for the both manufacturing and services sector continue to remain expansionary. Urban and rural sentiment seem to be improving. If you look at the rural data, you'd see that it's improving much better, and it is because of the Rabi crop is turning out to be good. So soil has moisture and water reserve levels are higher than 10-year average. There is ample availability of fertilizer and seed is better than last year. Put all of these together, Rabi crop is likely to be at all-time high this year, which is supporting the rural sentiment. Now, moving ahead, inflation is coming below RBI's target level, the upper range of target level of 6%. And for next year, RBI is expecting GDP growth of 6.4%, 6.4%, and they are targeting inflation to be around 5.3%. Moving ahead, the private sector is looking to invest, and there have been a lot of announcements. Let's hope and pray that all of these announcements get converted, because it might not that all the announcement real action may convert hota hai. But it's like that private sector and government are going to work together to revive the infrastructure investments. Moving forward, the capital expenditure is seeking a new cycle, which is led by industries like chemical and renewable energy, metals, electronics, and there is also availability of finance to carry out the capex expenditure. And both of these things bodes well for Indian growth. The aggregate capex is expected to grow more than 20% in the upcoming years, reaching to almost 4 to 4.5% of GDP. Now, this is a very interesting data. Indian factories are now becoming bigger and they are employing more people than before. Large companies, large factories will obviously size and scale, and they will become more competitive in the rest of the world. As economy is moving in high gears, they require financing, of course. which is where bank credit growth, both for businesses as well as retail and personal loan, is remaining at a very healthy pace, as can be seen in this graph. More importantly, these banks are lending money to the borrowers who are prompt in repayment. The gross non-performing assets of the banks are coming down to a decadal low level, and whatever is left is reasonably well provided for banking sector, as in it's a far better shape than it was before. Normally we have seen that the capex cycle creates capacities and then it results into higher profit. We believe current infrastructure investment cycle by corporate will result into faster growth next year, and the GST collections are also averaging at 1.5. Again, like पहले हमारा 1.4 we were crossing at more or less at a regular level. So let's see and hope that 1.5 becomes the new normal, because it is really good for our country's economy. As I mentioned before, that in this budget the fiscal prudence is visible, and the fiscal deficit of central government for FY23 is estimated at roughly about 5.9%. More importantly, there is a target of 4.5% over the next 2 years. Essentially, it means that चादर उतनी फैलाओ जितनी चादर उतनी हो जितनी लंबी अपनी पैर फैला सको. So, but do we mean that there are no challenges? No, India still faces a few economic challenges, undoubtedly. But yes, we are better than the world, but our challenges remain. And one of the biggest challenges, India's trade account deficit. We continue to import far more than what we are exporting, and we really need to take care of our credit trade deficit. Now, what can be done? How do we reduce import? Well, हम make sure कर सकते हैं कि we travel in India rather than going outside. We can make sure that we, instead of sending our kids to Harvard and Oxford, we can try to bring Harvard and Oxford to India, and let the neighboring countries' kids, African kids, come to study in India instead of paying $25 billion that we are spending on the import of coal. We can make sure that we mine our domestic coal. Today we are importing large amounts of gold. Today we are importing around 35 billion to 50 billion dollars of gold. We can reduce this craze for gold, and which can benefit the economy. Also, what we can do is work on reducing our import from China, which is running at a very, very high level, and it's threatening to touch $100 billion. So if we figure out a way of controlling our dealings with China, we can manage current deficit account well. For now, crude oil prices have softened, and it's a welcome sign for India. This softness is driven by one, increase in production, and second, reduction in demand, especially in developed worlds. Now, as we believe rebounds is due in the developed and emerging markets, can the oil prices again go up from here, or will they stay here, or maybe be in our favor and come down? Well, that depends, and that will determine what happens to our market. One more important thing that we need to talk about is exports. Everywhere in the world, which country has grown, they have grown by working on their exports. Be it countries like China, Japan, Germany, they became the powerhouse of exports. And India continues to be at a very low level of exports today in goods. Our market share with respect to goods is only 1.8%. सर्विसेज में थोड़ा सा बेटर है, around 5 to 6%, but then again we have to catch up with the world. We should try to copy China, Germany and Japan and increase our exports, which will be beneficial for our growth. Our market today is impacted by non-budget events also. Clearly, we must remember that India got premium valuation because our earning growth was better than the rest of the world. Peers are superior. Our growth was better than the peers. And this growth combination is dependent on 3G, that is growth, governance, and green. So we are expecting India to grow based on these 3Gs. Now, coming and talking about the growth and valuation, as I was mentioning, India has done better because of the earnings. So we are currently at premium valuation. Now, valuation has resulted in the outflow of money from Indian markets because all these countries के equity markets were available at low prices for China, Taiwan, Korea. So foreigners ने इंडिया में Indian equity में माल बेच के वो यहाँ ले जा रहे हैं. But again, what we believe is that this is a temporary thing. Once they find the value and the growth story of India, they are again going to come back in the following months. लॉन्ग चाइना शॉर्ट स्टोरी ये जो इंडिया का जो ट्रेड है ये गोइंग फॉरवर्ड दिस इज ऑफ कोर्स द गैप इज रिड्यूसिंग एंड पीपल माइट and the foreigners might soon starting to come back. This started in year 2021, but this will not continue. Moving forward, India's valuation has already started correcting, be it healthcare or IT, consumer, real estate. So all these different sectors, there has been a correction which will result in the inflow of money back to India. Now, valuation in India sectorial curve has, of course, improved. We are currently trading at 123 premium to MSCI India index and premium to emerging markets. So this will be justified if we deliver growth, governance, and green commitment. Thanks to DII, that is the domestic investors, the help and support, that now we have become major player. We are able to match foreign portfolio investors in a reasonably balanced manner, and this is resulting in low volatility in Indian equity market. Domestic investors have shown real courage. जब FPIs ने इस टर्म में 2,55,00,000 का माल बेचा, Indian investors bought more than 2,96,00,000 crores worth of equity. They put this amount of money like this. So now it is becoming difficult for FPIs to sell at these levels and then come back when DII have been continuously on the buying spree. FPIs again were selling in June 2023 and DIIs were handsomely buying this time also. Global peers compared to our historical advantage, we need to make sure that our equity valuations are justified. This will turn back the tide towards us. The market capitalization has corrected to GDP from 112 to 100. The banks and large caps are also performing well, are above expectation. Metals, oils are below expectation. So this is where we need to work. So if I have to wrap up what to expect going forward, I would say that be ready for volatility, because what I personally believe that Indian market mein there is no other risk except volatility, and SIP is a good way of managing and mitigating that risk, because whenever there is volatility up and down, SIP will make sure that your portfolio remains healthy. So for recommendation, I would suggest that one can be marginally overweight on the large cap, marginally underweight on mid cap and small cap, and for equities, equity Sadahi bull, I believe. So this is what I had to say for this month. Wish you a very happy investing month, and we'll meet again with the outlook for the month of March. Thank you.